Today's session will begin with a conversation with Nnamdi Okike, co-founder and managing partner of 645 Ventures. Nnamdi, welcome to the show. Your audio is not coming through.
I'm on the phone here. Can you hear me?
Now we can. Yes, perfect. All right.
Okay, great. Great. Pleasure to be here. Thanks for having me.
So tell us about 645 Ventures and your journey a little bit so we get to know you.
Yeah, definitely. So, we are a seed to Series A venture fund. We're headquartered in New York. We invest primarily in enterprise SaaS and enterprise infrastructure software. So we're investing in companies that are typically just getting off the ground, but typically have what we call early predictable performance metrics. So very large markets, great founders, and typically some kind of competitive barrier or competitive differentiation early on in the product. So we started our fund about 6 years ago now, so back in at the beginning of 2014. And really, the fund began really as a result of the experiences that myself and my co-founder, Aaron Holiday, had previously. So I'd spent about 9 years working for a fund called Insight Ventures. Insight Ventures today is one of the largest venture funds on the East Coast. They manage about $15 billion of capital. And I spent many years there investing. I had close to 20 deals I'd done. I had 9 exits, 4 IPOs and 5 acquisitions, and had really learned the venture business at Insight and had seen some really interesting businesses over that time. And then I wanted to take a lot of my learnings and move them to earlier stage and develop a fund that had a more systematic approach to investing. So I came together with my partner, Aaron, who is a software developer and engineer by background. And we started to build our fund almost 6 years ago now.
How big is the fund?
Yep. So we manage about $50 million. Our current fund is a $40 million fund. So we raised that fund last fall, and that's an institutional fund. So we have several large institutions like Princeton University and the Mellon Foundation, and some great high net worth individuals invested in our fund as well. So folks like Mark Andreessen and Howard Morgan, co-founder of First Round Capital, and Robert Smith from Vista Equity. So we've got some great LPs who back us. Okay.
And define early stage, define seed stage for us the way you see it. Because as you know, the venture business has fragmented quite significantly. So early stage or seed stage is no longer one moniker, so to speak. People have their own definitions. There's pre-seed, there's seed, there's post-seed, pre-series A, small series A. So all of that falls roughly in the seed and early stage bucket. So where do you fit in that spectrum?
Yeah, no, that's a wonderful point. There's really been a fragmentation, so to speak, of early stage, and it's really resulted from a lot of different factors, right? Everything from this proliferation of micro VCs, there's been a rise of crowdfunding, there's been growth of super angels, and all of those entities kind of play in different places. So the way we define it really is companies that are early product market fit, and what we describe as early predictable performance metrics. And I can kind of describe how we look at the world. So our belief is that there's a lower amount of capital required to really get in business. You don't need to buy servers. You don't need to do very expensive sales and marketing. And so as a result, companies, especially companies that are selling downloadable software or software for SMBs or even enterprise software in some cases, they can get started with a small amount of money. They can raise, say, $500,000, from an angel group or from a group of investors and really get in the game. And we kind of define those rounds as pre-seed, kind of typically the kind of get in business type of rounds. We typically look at the round after that. So what we're looking for are companies that have typically built an early product, you have some early traction. So if it's software, for example, selling to small businesses. Maybe they have 10 early customers or 15 early customers. Early use cases where we can see, do the customers like the product? Is there early evidence that they're willing to pay? But typically these are companies that don't have a lot of revenue. Usually when we come upon them, they may have a couple $100,000 of annualized recurring revenue, but they're really looking to scale up. And typically they have a big market opportunity and founders who have a high level of dedication. And what we do is we typically invest to help companies scale to Series A. So, we're typically investing on average $750,000 to $1 million in a round. Usually the rounds that we lead may be $2 to $3 million in size, and that's sufficient capital to enable the company to really scale to a Series A round. And what we look for are companies that we believe can get to, very competitive Series A rounds led by the top firms. And so if you look at our portfolio historically, we've had firms like Charles River Ventures, Index Ventures, Bessemer, and Andreessen Horowitz kind of lead the Series A's and Series B's of our companies. And what we look for are companies that can get to that stage. And we view it as our mission and our goal is to really work with those companies to kind of help them get to that next level and to put the pieces in place to do that. And that's helping to build the sales team, helping to build the engineering team, helping them really think through the story and the brand of the company and really, help them get to the next stage.
So what about geography? Is this happening around the country, around the world, just in New York? What's your preference?
No, that's another great question. So one of our core beliefs is that in today's entrepreneurial environment, you can start a great company from anywhere. And oftentimes, if you're a software entrepreneur, it is even advantageous to start a company in a smaller city where you can get access to the best talent and where there aren't as many companies competing for the best engineers and salespeople. So the way we run our model is we call it outbound sourcing. And what you've seen historically is that outbound sourcing has been applied very effectively at the growth stage at firms like Insight, where I spent many years. But historically, growth stage, the outbound sourcing wasn't applied very well at the early stage because historically there wasn't a lot of data on startups. Startups took more money to get to the next stage, and it was very hard to run a sourcing model. But we believe that's now changed. So if you think about our model, what we do is we use our own internal data, software, analytics, and we have a sourcing team of folks who proactively call on companies. And so just to give you, one case study, the most recent deal we did is investing in a company called Adea, which is a very high potential internet security software company. And this company was founded by the former CIO of a company called Duo Security, which is a $2 billion plus acquisition by Cisco. This company is in Detroit, so it's located in Michigan. Duo, as you may know, was also in Michigan, and so there's a lot of great alumni and folks who have built their careers at Duo that may be looking to join a new startup. And the way we found this company was really through our own internal analytics. We were able to identify this founder as a very high potential founder, reach out to him proactively. His name is Raffaele Mautone, and we're able to lead his first venture round. And so that's really reflective of our model. It's an outbound sourcing model. And so if you look at our portfolio, we have investments, obviously in New York where we are located, but we have investments in, down in Texas. We have investments in the Bay Area. We have investments in DC and Boston. So we really run this outbound sourcing model, and we look for the best companies wherever we can find them. And our belief, again, is that, today's entrepreneurial environment is producing great companies in a much broader set of locations than has happened historically.
Well, and also I think it's much easier to build companies when you don't have your staff being poached all the time, right? It's not just easier, it's kind of impossible to build a company if your team is constantly being poached. So if you're located in a major location where there is a lot of competition for talent, it's very, very problematic, very troublesome.
That's a great point. That's a great point.
So the other question I have is, you do both B2B and B2C, right?
Yes. Yeah.
So you said,
go ahead. Sorry. Sorry to interrupt you. Go ahead.
I wanted to elaborate on the questions. Like you gave the example of the, let's say a company is selling to small businesses and you want to see about 10 customers, 10, 15 customers to see validation. Could you complete the picture and talk about what do you want to see in validation when it comes to a B2C business? Because the metrics are different. What constitutes something promising is different. So how do you think about B2C validation?
No, that's a great question. And as you described, we do both B2B and B2C. Probably about 75% of our deals are B2B, so majority is B2B. But we do some direct-to-consumer as well, and we have a couple of companies that have gotten to a large scale on the consumer side. So I can talk through a couple of case studies and just describe it. So on the consumer side, we look at a couple of different things. The first thing we think about is what's the quality of the business model, and is there early evidence that the business model is working? So the way we would size up, for example, a consumer marketplace might be a little bit different than the way we size up a digital media company. For consumer marketplaces, typically you can see early transactions, you can see something called take rate, which is the gross margin. You can see frequency of purchase. Whereas digital media company, you might want to see more growth in users and more growth in activity because the business model may be later in coming. So we think a lot about quality of business model, and is there evidence that this business model is starting to manifest itself? So maybe just to give you, a couple of examples. For example, on the online marketplace category, we're investors in a business called Goldbelly. Goldbelly is a direct-to-consumer marketplace that enables customers to access what they call local legendary food makers. So these are food makers around the country who, have local followings. People love their foods, but these food makers may want to sell nationally. And Goldbelly provides a platform for them to do that. So they provide marketing, they provide an e-commerce platform, they provide, they connect them up with FedEx for shipping. And so we describe it as kind of the hub for food makers to be able to sell nationally. So if you look at our investment in Goldbelly, when we first came upon that company, they had done roughly about a million of gross transaction volume in their first year, and they were tracking to about 3 million of gross volume the next year. And so they had early evidence of revenue, and they were really showing that they could bring on food makers. I think at the time they might have had 30 or so different food establishments on the platform who were selling. And when we looked at Goldbelly, the thing that was most interesting to us was a combination of the frequent purchasing by end customers, the high level of satisfaction, and obviously the growth in revenue. And so we were able to get comfortable with that business opportunity, invest in their kind of what they call the second seed round, and then reinvest at the Series A. And the company subsequently has gotten to very large scale. So that's an example of a marketplace deal. A second one I might describe, which is in a different category in consumer, is a business called Overtime. Overtime is headquartered in New York. I describe Overtime as ESPN meets Snapchat, so very viral content that's oftentimes user-generated, really focusing on the millennial generation who consumes sports content in a very different way. They're looking at highlights, they're sharing things on social media, and oftentimes they're not watching a full game. They want to really get inside the game and understand the players and the players' lives. And so when we first came upon Overtime, at the time they actually were pre-revenue, but what we were seeing in the business was really rapid growth in views, in shares of videos, in frequency of use by users, and they were really starting to develop a real following in their target demographic. And so our belief there was that the behavior that we were seeing that Overtime was showing could really translate into revenue over time, and it has through a combination of commerce and advertising. So in an area like that, it's much more about the behavior of the users rather than a specific, revenue goal, so to speak, or revenue milestone.
And what business models are you comfortable with when it comes to media? Because, media has really got slaughtered, right, in the last few decades.
Yeah. We don't do a lot of media, but I think in the case of Overtime as an example, what we like to see there is a couple different things. I think we like to see businesses that have evidence of a differentiated voice, a differentiated content strategy, typically a low-cost content strategy. So in the case of Overtime, because almost all the content, most of the content is user-generated, they have a much lower cost of content creation. But we also like to see kind of a multi-tiered revenue model. So as an example, Overtime has a commerce business. They sell apparel, they sell products to customers, and they've kind of complemented the traditional, advertising-driven revenue model with a commerce business, which we think is really smart and provides kind of a more balanced approach. So again, we don't do a lot in digital media, but where we do it, it's a combination of very large market opportunity, good business model, typically multi-tiered business model, and a belief that this can be really disruptive to larger incumbents and where, we think the market opportunity can yield a large company. But again, it's few and far between because as you described, there haven't been a lot of examples of media companies that have been those kind of billion-dollar exits.
Mm-hmm. So in terms of your outbound sourcing, does it include international companies that are, building elsewhere and then trying to come into the U.S. perhaps, or maybe working on different markets?
Yeah, no, that's a great question. And for many years before co-founding our firm, I did a lot of international investing. So I was investing in Europe and Latin America and had several exits in those markets, and so have good experience kind of investing in international markets. And I agree, there's a lot of opportunity in many different parts of the world. At our firm, when we began, because we wanted to make sure we could work closely with our companies, and we just have one office in New York, we began focusing on the U.S., focusing on companies domestically. But we've started to broaden that a little bit over time. So we've done two investments in companies that began in the UK, Storage OS, and a marketplace company called Fat Llama. So we've been active there in Europe. We'll continue to be, and I think over time we will broaden out. So we will eventually look to LATAM. We'll probably eventually look to Asia. But the nature of the outbound sourcing model is one where, although you can identify the company internationally, you also have to be able to add value. And so one thing we think a lot about is, over time, can we build a value add team, what we call a success team, to be able to really help companies with the challenges that they have and the growth opportunities. And one thing we do look for where we're doing a deal outside the U.S. is a local partner, a firm that can really help us, that has local domain expertise, and can kind of add value in areas where we may not have all of the expertise. And so as we grow and expand, I think we think a lot about having local relationships with great partners.
All right. What trends are you seeing in your deal flow? If you look at maybe the last 18 months deal flow, what strikes you as emerging trends? Yeah,
definitely. There are really three themes that we use to kind of guide our sourcing strategy, and I can kind of go through each of them. And these themes really have evolved as a result of what we're seeing in the market, as well as where we've done well historically, and our belief around kind of what trends are going to be driving the areas that we focus on. So the first is what we call software for the second wave, and we describe that as verticalized software companies that are pursuing market verticals that historically have had low software penetration, but now kind of given the evolution of software, given the proliferation of mobile phones, enable workers in those industries to really kind of improve how they do business. And so if you think about, examples of that, you're seeing it in a lot of different areas. In construction, you might have seen the recent acquisition of PlanGrid. You're seeing it in areas such as real estate. We've been pretty active in a couple of different categories within there. So as an example, one of our most recent deals that fits that thesis is a business called Squire. Squire provides software for the barbershop and salon market. Now, the barbershop market historically hasn't really used software. You go to the barbershop and you sit there and you wait for your haircut, and typically you pay with cash, and typically you don't have the ability to book via mobile phone, and you can't use your credit card, and the barbershop itself typically doesn't have software for payroll, and what we found now in that industry is that barbershops are much more willing to adopt technology because they can make their businesses run better. So that's really what Squire does, and it's really kind of representative of that theme, software for the second wave. That's the first theme. The second theme that we are really looking closely into is what we call citizen professionals, and we describe citizen professionals as an area where the tools of data science, data analytics, advanced algorithms can enable workers who aren't necessarily experts in certain areas to become like experts. So as an example, a company like Tableau is a good example of that theme, where now folks can do really advanced data visualization and data graphs without necessarily having a PhD in data science or programming. And so we're seeing a lot of different areas where that approach is starting to manifest itself into new startups. So everything from financial analysis to the legal field to the accounting and financial field. So this theme of citizen professionals is one where we think there are going to be a lot of interesting startups kind of coming out of that really improve how the average worker kind of does their daily work and enables them to really have the skills that, are similar to what you might have seen with very expensive experts over time. And then the last theme is what we call personalized consumer experiences. And I think I touched on it a little bit in describing some of our consumer investments. One of our beliefs is that you're going to see a new wave of consumer companies that provide much more personalized experiences. So one example of a business that fits that theme that obviously has been very successful is Stitch Fix. And if you think about what Stitch Fix does in terms of providing personalized, personalized styling experiences to customers using really advanced data and data science combined with a personal touch. And so that's one example of a business that, kind of fits that theme. And we think we're going to see a lot of new startups that are in those categories over time. And so we're looking for that next wave of startups that provide these personalized consumer products and services using data, typically, leveraging the internet, and oftentimes, having new cost advantages versus incumbents that don't have nearly the ability to tailor their products and services to customer demand. So those are the three themes we're spending a lot of time in, and we're looking for great startups that are fitting those themes.
So I want to comment a little bit on your personalized consumer experience theme. I did one of the first ever online fashion companies, personalized fashion. It was very early, 20 years ago. So the data was not quite there at that point. But but now, of course, that's something that a lot of people are working on. But this is a category of products that require quite a bit of technology development to work. So, so the question is a bit of a subtle question. You want to come in after there is some validation. Is there a group of investors that you're working with who are willing to do the earlier part of this kind of business development? Because this is not something you can do on the back of a napkin.
No, that's a very good question. And it's something we struggle with a bit because, when we find an exceptional founding team that may not have yet, even a prototype, it may just be an idea, we debate a little bit internally, should we jump in a bit earlier and invest and help the company kind of build some of those tools and build the team, because as you described it, it's not cheap to do that. So I think we'll do that a bit more, especially with founding teams where we have a lot of conviction around their ability to build. But I would say more generally, we do partner with different types of investors. So we are oftentimes partnering with what you might call pre-seed funds, folks that are writing that first check when it really is just an idea on a napkin. And there are several pre-seed funds that we really admire. So as an example, Charles Hudson and Precursor Ventures, we think he is very good in identifying, really top founders who are, just looking for that first check to kind of be able to get into business. We have Notation Capital, which is in New York, which does good work. There's another fund, A4 Capital. We just actually invested in a company after A4 did the pre-seed. We invested in the traditional seed and led that round. And so they're a great fund that really does that first check. So So we do look for partners who are a little bit earlier than us and can provide that first check. And we also do work with angel investors as well, who can provide that capital. But I think over time, as you described, we may be a little bit opportunistic there, where we see an exceptional team in a big market and maybe write a little bit of a smaller check ourselves to be able to be in that round and start to work with the founders and then be able to write a bigger check as they get to, more of a larger, institutional seed round, so to speak.
Yeah. Yeah. These are not quite as lean startups as some of the other categories we've discussed. Personalization is heavy-duty technology, so you need a technical founder who can access the data on which to run the personalization engines. For that, they need to do some biz dev potentially to get access to the data. So it's a lot more complex than the traditional lean startup model that we've. I think the ecosystem has scaled the lean startup model very nicely, and we're seeing great bootstrap startups come out. But I think there's a case to be made about building a bit more of an infrastructure and ecosystem to do fast startups to solve some of the problems that we're talking about as well.
Yep, you're exactly right. These companies do need advanced technical teams. They need technical founders, but they also need, early capital to be able to test things out and really get the algorithms correct and have a large enough training data set to be able to, to provide a product that starts to work. So I think you're exactly right.
Yeah. All right. Well, very nice conversation, and I love the way you have really, articulated the three areas that you are interested in, and it's very specific, very well thought through. So congratulations on that.
Oh, really appreciate it. Thanks for the opportunity to join today.